Good afternoon, everyone. David Scherer, CEO, co-CEO, I should say, and co-founder of Origin Investments. Thanks so much for joining us. This has sort of become an annual tradition now. We've done this for at least 5, possibly 6 years. If you're unfamiliar with the format, I come up with predictions around this time every year. We publish them, and we're going to be publishing these predictions, and they're always around real estate, but they also expand because it's necessary to have opinions about the economic drivers, interest rates, GDP, employment, as it relates to real estate. So the discussion will be broad, and then we publish the following year the accuracy of the predictions. Historically, over the last 5 years, we've been 87% accurate. We haven't published the 24 predictions for 25 yet, meaning the grading of it. That should come out in the next few months. I was talking to some of our team members today. I think they're going to come in around the same, sort of in the 80s to 90s, so it won't move the data set much. In terms of the amount of partners, there's many partners on this call, but also just people that are interested in real estate and the economy and what we see going forward. We welcome all of you. If you're a partner, thank you for being a partner. If you're someone that's interested in real estate and you want to learn more, in particular multifamily real estate, rental housing in the US, welcome. I'm happy to have you on as well. My goal is to have the presentation, and it's just going to be me. Although I will say I leverage heavily our team. Origin has 70 team members, many of which are experts in their vertical. So I'll just give you an example. When I'll talk later about operating expenses in multifamily or construction expenses in multifamily, I'm leveraging people with 25 years of experience in those verticals of multifamily, and trends that we're seeing in both tend to stay in motion. And so one of the reasons I can be accurate, much higher than call it a coin flip, is if in November of this year there's a trend that's either holding steady or accelerating in a direction, it's likely going to continue into 26 unless there's an externality that moves it. So I want to just sort of give a shout out and a thanks to the whole Origin team, because this has become much more than the David Scherer prediction webinar. It's more a reflection of Origin, our team, and the collective resources, data, and experience set. So the format is we'll do about 25 to 30 minutes of presentation. Sometimes I can take a little bit longer than that, but that's the goal. There were dozens, possibly 100 questions sent in, and we grouped those into themes, and I have a lot of those ready. But please add any questions that you have that come up throughout the course of the presentation. There's a Q&A box, and I'll try to stay on as long as possible. Obviously respecting your time as well. And so with that, I'm going to get started. Oh, last thing, there's just over 1,000 people who registered. I think probably half of which are on live, and then there's awful lot of folks that view things on recording later. You will receive the recording tomorrow. You'll also receive the presentation that I'm about to go over as a frame tomorrow. And then lastly, the article itself has just been published. We didn't want to send it until the webinar and steal my thunder, whatever that thunder is. And we will be also sending you a link to that article, which also will be in our education center at origininvestments.com. Okay, so I'm going to get started. Okay, so we're going to go through 11 predictions. The first prediction is AI will disrupt employment and productivity without impacting GDP yet. And so there's two things happening in AI right now. One is it's not a prediction, it's just an observation. There's this unprecedented, I would say the only thing I've seen similar to it was the internet infrastructure period in the mid to late 90s into the early 2000s, which sort of coincided with the Y2K infrastructure buildup. We're in that period, Um, no one on this webinar, including myself, has more than an opinion on what will then happen, how much AI adoption there will be, how much efficacy the AI itself will have, what the growth rate is of AI. Do we get to AGI? There's a lot of questions that are unanswered, but what is not really debatable is there's an unprecedented amount of investment into AI infrastructure. And what's really interesting is, between having to build out the power necessary, having to build out the data centers necessary, having to build out the chip capacities necessary, it's creating a part of our economy that normally isn't the driver. The driver of U.S. economy is consumption. We consume things in the U.S., and this is really about building capacity as the next gen, if that's what it's going to be, producer of something. And so, like, on the one hand, it's actually really exciting if you think about the U.S. reinventing itself as the leader in the next industrial revolution, if you will. That's exciting. But with that comes a lot of uncertainty. The obvious uncertainty is, what if we're building out all this infrastructure and it's disruptible? So that's a risk taken on by the hyperscalers, anyone that's investing a ton of money into capacity. What would happen if you wound up not needing that much capacity because perhaps the demand isn't as high as you modeled or forethought, or perhaps technology itself creates the ability to have AI with less chips, with less electricity, with less data centers. And that's a pretty reasonable argument, actually. Usually, just to give you an example, the Apple phone that all of you are looking at today has more capacity than the largest supercomputer of 30 years ago. And yet it's in your hands. So why wouldn't that also happen here? So these are questions about their unit of risk. What I'm certain of is GDP for next year, because this is a one-year prediction. I think GDP will remain reasonably high because there's so much investment still happening, and so, like, I'm pretty bullish on the next year. In terms of company profitability, this is the kind of if-then. If there's adoption by companies and it's successful, meaning they're able to get more production from their workforce and grow without hiring more people because they're leveraging technology, then in the beginning, you're going to see earnings go up, and that's good for the stock market. The challenge with that is if we're producing GDP that's quite high or remaining high, GDP is just a unit of output for the economy, but you're doing it with less labor. Then over time, you have a purchasing power that's lower from the consumer itself because they're less employed. And so now you're talking about a low inflation environment, right? Where you have the inability of companies to raise price because the consumer can't afford it, but they're also able to produce at lower prices. So their margins are staying similar. These are all potential realities. And I'm not here to talk about the long-term, medium-term of AI. I'm really just trying to start a conversation, and we can handle it in Q&A. I do think AI will be a net job producer next year, as the capacity building phase, I'm certain, will continue. And I think the disruption phase, which essentially means you have less labor doing the same amount of GDP production. The other thing I would tell you is at every time in human history that there's been a big disruption, and first it was agricultural going to industrial, and then it was industrial going to service, and now it's service going to potentially AI. You could group the internet in there as well. There's been people, and I'm sort of doing it, saying, I don't know where all the labor is going to go. It's being disrupted. And humans have always figured out ways to reinvent and become even more productive somewhere else. And I do think that that's possible. And it's also, there's AI that will lower the barrier to entry of new business. And so, for example, my son, who's 17, is interested in investing. And I was working with him on how to look at public markets and evaluate individual stocks. And he took those concepts and he used AI to program an app. And it's actually, I don't want to say it's easy, but it isn't. The barrier to entry to creating an app that's pretty good, actually, is so much lower than it was a year ago, 2 years ago, 3 years ago, because AI is writing the code and it's doing it at a pretty high level and it does it pretty quickly. And so like that would be an example of AI creating lower barriers to entry to new business, which then it becomes about client acquisition and client service, client retention, branding. You still have to build a business, but you're not, spending $500,000 to build the app, because it can be done for $2,000 in a week, right? And so there could be an awful lot of innovation that also is unleashed. This slide is talking mainly about GDP, and it's GDP in the short run. And this is what's been happening. There's been quite a bit of volatility this year in GDP, quarter by quarter. But in general, on an annualized basis, our GDP is growing, and it's growing, at that sort of 2.5 to 3.5 level. And I see that continuing in the next year. That's what I would use as a prediction and take from this slide. And obviously, there's a lot of noise, and a lot has happened this year. We haven't talked about the tariffs and the new sort of paradigm that was introduced in April of this year, but an awful lot's happened. And I think we can agree on one thing, which is the U.S. has proven to be an incredibly resilient economy and an incredibly resilient investable asset as well. The second prediction is Origin's target markets are positioned for a broad rent recovery. I will tell you, and by the way, these are the markets we cover, so they're not arbitrarily selected. This is where we invest. We get a lot of data, both from our own assets, but also from our proprietary machine learning, Multilytics, which is pulling in billions of pieces of data a month. And I get a lot of questions about like how do you how's that possible to deal with that amount of a data set? And one of the really two things that we leverage, which has been quite fortunate for us. One, we've invested very early on into AI. I mean, this started at Origin in 2019, so long before it became a household word or acronym or whatever, we were doing this because we didn't see that anyone in the market could do it. At any point in time, we have either 3 to 5 data scientists that are working on this, and most of them are PhD students that are also either working full-time or part-time for us. And one of the things that's wonderful is we get to leverage their brains, and the other is they have access to free compute as data students, science students at these large academic institutions. The academic institutions aren't, they're not renting their compute from Amazon or other providers. They've built their own supercomputers to do this. And in fact, they're encouraging their students to do things like this, right? To sort of explore the frontier of what's out there. And so we're very fortunate to have that as well. So what is it saying? I mean, broadly, this is our growth rate. And so just to put it into a frame, rents in the U.S. have grown over the last 100 years at just under 3%, right? So if you're looking at this data set, and we're predicting, anywhere from 3% in some markets, 2.8 in Austin is the low, to 5.7% in Charlotte. That's as a frame, that's 85% higher than historical rates. So that's much higher. And the answer, why? It's very simple. And I know if you're a client at Origin, very complicated models, but the concept isn't. Um, Once Silicon Valley Bank failed in 23, you had two things happening. One, the Fed took rates from 0 to 5.25, which was the fastest pace of rate increases ever in the history of the country. I mean, we were coming off zero, so it's kind of infinite. But that was shocking, and it took about a year to break something. And what broke was Silicon Valley Bank. They had invested in short-term securities, bonds. But if you buy a 2-year note at zero yield and it goes to 4, that's a pretty significant loss. And that's what happened. And so they were taking losses that led to a bank, basically a run on the bank. And Silicon Valley Bank failing wasn't that it failed, it's that all the regional banks saw it fail and then went into defensive mode and they stopped lending. And so at the time, the Fed was trying to kill inflation, and this actually kind of helps the Fed because when banks stop lending, it affects the M2 and M3 money supply. So it's pulling even more money out because they're typically multipliers of money, but they're not doing it. But what wound up happening for multifamily is starting in 23, new housing starts in multifamily just started to drop, and it fell quickly and it endured. So in 23, it fell quite a bit. In 24, it fell more. In 25, it kind of stayed along the bottom. And in a lot of our markets, we're 40, 50, 60% peak on new starts. And now we're talking about 2.5 years of that. And so when I look out into the future, like generally, it takes 2 to 3 years to build multifamily. I might add, we're already underhoused as a country. But right now, there just isn't the next unit of supply coming because it should have started in 23, 24, 25. It didn't. So the next years in multifamily, we can talk about the demand curve, and I will, and that's what's uncertain. The demand curve is uncertain. I don't say that being negative. It's just no one on this call knows what demand is in the future. You can have an opinion. The supply actually is known. The supply is going to drop by tremendous amounts because it hasn't started. It needed to start in 23. It needed to start in 24, and it didn't. And so this is why we believe, I'm making an assumption, and so is Multilytics, that look, the demand curve will remain similar. We're not suggesting it's going to increase, but we're not suggesting it's going to decrease. And we'll get into the reasons why there. But the supply will go down quite a bit, and there's nothing we can do about that. That's already happened. So I'm certain of that. I will answer one question preemptively. And that question was, well, I know, but Multilytics predicted, and I reflected this because I agreed with it, that these increases in rents would start in mid-25, and they haven't. And that's actually true. And the reason that it's still, I would say, at equilibrium, and we're seeing like flat rents, it's not going up yet, is there were so many projects that were delayed. They were started in 20 and 21 and 22, but there were delays by the municipalities because they were overwhelmed. This was the cheap interest rate environment before the Fed started raising rates. And you had an overstart, like too many multifamily starts were happening in 2021. They overwhelmed the system. They were having to deal with inflation in construction. And so a lot of these deals had to be value engineered and then resubmitted for new plans. And just all along the way, deals that should have taken 2 to 3 years wound up taking 4. And they're literally hitting right now. And so there's been an extended period of supply hitting. But I don't think it changes the net. Like, in other words, if Multilytics and I believed that in 28 rents would be at X level, I still believe it'll be at X level, but the slope is going to be a little bit steeper because we've stayed along the flat line longer because of the extenuated period where there's supply that's taking longer. In other words, I think rent growth will be more explosively high in the next 2 to 3 years to make up for this period, is my opinion. What would change that reality would be something in the demand segment. So if something in the economy changed, a deep recession, a secular change where for sale housing became much, much less expensive. Usually that's a severe correction in for sale housing. Those are the types of things that could change the demand curve. But I'm a big believer in the most likely reality in the future is the one you see. And so I'm making an assumption that demand stays static. The third is interest rates will hover between 3.6 and 4.6. When I say interest rates, I'm always talking about the 10-year rate. That's the 10-year note yield. I think it's the most important rate for multifamily investment. It's certainly the one that's used. I'd say the fives are probably second, because when we stabilize assets, they're always priced on a fixed rate, and that's where we like to refi to fixed rate debt. It's a spread over the 5 or 10-year note yield. So my logic is pretty simple. I believe there's a real probability that with what's happening with AI, automation, and when I say automation in all of its forms, a lot of these, it's not theoretical. I was just in Phoenix and there's Waymos all over the city. I mean, if you want a driverless taxi, just use Uber, it's there. And similarly, so many cities. So like these things aren't out in the future, they're happening. So when Uber drivers are no longer as prevalent because they're being replaced with a much lower cost solution, that's a secular move. Same with robots, if we ever got to that point in manufacturing. Same with white collar, if AI was disrupting that. And there are some indications that that's happening already, right? So, for example, unemployment amongst recent college grads has gone up quite a bit. It's still low, I believe it's plus or minus 5%. But 2 or 3 years ago, it was 4.2. So as a percentage, it's gone up quite a lot, still low. And I would also say that anecdotally, I have a lot of very talented recent college grads in my network. It's just the age I'm at, where a lot of us have children who are in college or just graduating college. And it's much more difficult to get entry-level work than it was a few years ago. Now, is that because the Fed raised rates? Maybe. Is it the early innings of AI? Maybe. That's what's unclear. But I can tell you, just from a data and an anecdotal level, it's noticeable. It's sort of happened. Like you can't deny it's happened. You can debate why it happened. But here's my point. And my opinions are changing constantly. If you had talked to me 6 or 12 months ago, even 6 months ago, I would have said, I'm more concerned with long-term interest rates going up. And it's twofold. One, inflation is still, depending on how you're measuring it, let's say 2.6 to 3%. That's a bit high for where our target is. We want it to be 2.2. So as a percentage, again, if you're at 2.8, that's 25, 30% higher than target, right? So that's not good. If you think about as an investor, if inflation really was, let's just say it was 3%, I'm taking the high end to make a point. If it's 3% and you want to have a real return on your money to buy bonds, to buy a 10-year note, and that typically is about 1 to 1.5% over time. It can get to 2, it can even go sub 1, but let's just say it's 1.25, 1.5. That gets you to a yield of about 4.25, 4.5. Right now we're at 4.1, 4.15. So it's all defensible. It's defensible where the yield is relative to inflation, relative to where you want to have a real return be. I also believe that with the amount of debt, and I write about this in the article, so we're sitting at 38 trillion of debt, and the average duration of debt is plus or minus 3.5 years. that means that you need to refinance roughly a third of that debt a year. And so let's just do simple math. That's 13 trillion of debt that has to find a home every year through refi. It's coming due. It's not a 30-year note. It's on average a 3.5-year note. That's because some of it's T-bills, some of it's 2 years, 5 years, 10 years, 30 years. But it needs to be refied constantly. And then we also run a deficit. And depending on the year, let's say it's 1 to 2 trillion. So there's 13 to 15 trillion that has to come to market every year. And that's an awful lot of product that needs to be sold. We've always found buyers, domestic, foreign, pensions, investors. But it's real pressure. When you hear the term crowding out, that's what it means. Like if there's so much government debt that's asking investors to invest in it, it can crowd out other investment. And it can put pressure on long-term interest rates. So if you would talk to me 6 months ago, I would have been more apt to have a little bit higher. I'm not suggesting that rates are going to 6%. I just would have been 4 to 5. And the reason I lowered it for the 3.6 to 4.6 is more and more I actually believe that there's a real probability, it's significant, that we're going to have a secular force that is deflationary. And it's deflationary because companies are going to be able to produce goods at lower prices. And it's deflationary because if labor, and this is for the first time, it's white collar labor too. If labor can't find that next best and highest use for their unit of labor, you're going to find people that are disrupted. And I'm not trying to be Pollyannish. There are people out there that are, saying really extreme things, and who knows if they're right or wrong. But I do know that there's certain areas of the economy. I'll just pick one: computer coding. Computer coding 5 years ago was the fortress major. You majored in coding because it was the ticket to a great career. It could be unbelievably great. It could be pretty good. It could be good, but and it was the best and the brightest. And they went into these areas. AI has really disrupted computer coding. Just as an example, my son was a freshman in college. Now he's a sophomore, and he was taking a stats class. And it turned out that there was a lot of coding in it. And he was asked to do problem sets, and you would have to answer them in code. And he literally sent me a screenshot of his work, and then next to it was ChatGPT. It wasn't even the advanced subscription one. And he had typed in the problem and how would you solve it, and the code was the same. And he had spent 4 hours on it, and it's the same. And so his whole point was, he's like, look, I understand I'm learning how to think, but this doesn't seem that useful of a skill when I'm barely keeping up, and it took it 5 seconds. So there are areas that are being disrupted. Though people in those areas are obviously highly intelligent, and then they're going to need to find a way to reinvent and move their skills somewhere else. But I do think there's a probability of, maybe deflation's too big of a word, a lack of inflation, because I find it hard to believe that labor markets are going to continue to grow up at 3 to 5% in terms of compensation when you have this secular force that's really looking at efficiency across almost every part of the economy. And so that's why I lowered the outlook, 3.6 to 4.6. I haven't talked about the Fed, but maybe we can handle that in Q&A. And by the way, the reason I don't focus as much on the Fed is whatever the Fed is doing, it's definitely relevant to the interest rate curve, but it's much less relevant to the 10 years and the 30 years. And oftentimes it has the wrong effect that you expect. So I'll give you an example. When the Fed stopped tightening and they started easing, the initial knee-jerk reaction in the bond market was, oh, they're easing, let's lower yields. And then a weird thing happened. The yield curve inverted. And what I mean by that is it was an inverted yield curve, meaning the 2-year note yield was above the 10-year note yield, which usually portends a recession. And when they started easing, the front end of the curve came down at the same time as the back end of the curve went up. And the idea there was, look, you can move the front end of the yield curve, but what's happening with the expectations of tariffs and inflation was a bigger force than anything else. And so you have this massive moves between the 2s, 10s, and 30s. And now we have a yield curve that's normalized, meaning you get paid more yield the longer duration risk you take, with the exception being at the very front end of the curve, the 2s are still below Fed funds or the Federal Reserve overnight rate, target rate. And that's because the 2s are pricing in future rate cuts that haven't happened yet. And so with the exception of that, you have a yield curve that suggests a normalized, healthy economy, which is actually a good thing. But my point is, don't always look at the Fed and say, oh, they're cutting, therefore 10-year note yields go down. That's just not the case at all. It's really about future expectations of inflation and growth that are driving that. And then maybe a related is the amount of bonds that need to be brought to market, right, as well. Okay, so multifamily fundamentals will strengthen and the affordability gap will stop expanding. This slide, I have to speed up, by the way. I'm not doing this fast enough. This is a slide many of you seen if you're our partners, but this is extraordinary to me. If you look at this, you've got the ability to own a home and all the expenses associated with. So this is the mortgage payment, insurance on the home, property taxes on the home, maintenance on the home versus renting. And these are like kind quality homes. So one is a rental, one is an ownership. And you're talking about a 64% spread, less than $1,900 a month to rent or $3,000 a month to own. It really isn't, like, I don't even think it's sustainable, what's happening. And what's really interesting is if you look back, this is a very new thing. I mean, look where we were in 20. It was parity. 21, parity. And then you had this huge move. And it's pretty obvious why, right? I mean, the low interest rates produced this enormous increase in the price of for sale homes. And in the short run, it produced a similar increase in multifamily homes. But the multifamily side of it corrected very quickly when the Fed started raising rates because we're very economically driven. And so the multiples on our earnings, meaning multifamily earnings, at the height, we were getting a 30 multiple on earnings, which doesn't make any sense. That's when we were trading a 3.5 cap. You shouldn't get a 30 multiple on earnings on an asset that grows at 3% a year. I already covered that. Our rents historically grow about 3% a year. Anyone trained in finance knows that that doesn't work. And so, but what's interesting is multifamily multiples now aren't 30. They're 18 to 20. And I'm talking about Class A, great assets, good markets. We've been really de-risked. And that's one of the reasons I like multifamily a lot right now as an asset class is it's not just about the fundamentals. That's interesting. It's always the fundamentals in conjunction with the growth expectations priced into the asset value. And I think that we have very low growth expectations embedded in our cap rates, which went from 3.5 to plus or minus 5.25 today. I like that, right? That's something I like. And if I look out, and this isn't just me, there's a lot of articles floating around now from highly respected money managers talking about, look, if you've been in stocks, you've been right. And the growth rate in stocks has been exceptional for the last 4 or 5 years. A lot of it's AI driven, but it's just the markets have gone up a lot. And now if you look across multifamily real estate, our asset prices have been essentially flat for 4 years. And so it's just to me, it's just responsible investing to rebalance. And so if you were fortunate and you bought NVIDIA at $100, well, now it's trading 180. People are nervous because it was 200. Well, guess what? In April, it was 100. So you're doing just fine at 180. It might go to 500. It might go to 75. I have no idea. But rebalancing is part of what I think is responsible investing. And in particular, multifamily is just, it's a tried and true asset class that's kept up with the stock market for 30 years, 50 years in terms of all-in return, dividends, and compounding, with the exception of the last 3 or 4 years. You've seen a divergence. And so it's, in my opinion, a good place to take a look again. And so that's, this is about this unaffordability. This is our demand. And so if you're not able to buy because it's $1,200 more a month to do that, I'm not even getting into the down payment necessary, the opportunity costs of not having that down payment money to invest, flexibility, all these other things. But it's literally $15,000 a year more every year, you're going to rent. And that's our demand segment. And I'm saying this year, I don't expect this to widen more, but I expect it to stay at this really wide area, kind of like where it's been 23, 25. If you look at the bar graph below, it's flatlined, but it's flatlined at this extraordinary chasm that was parity 4 or 5 years ago. So this is multifamily. When we say activity, we just mean the purchase and sale of multifamily assets. And you've just seen there's been a lot more transactions. You can see that it peaked in 2021. That shouldn't surprise you. The debt and equity market was frothed with capital, and that's kind of what fuels these transactions. And it's come down quite a bit, but you've also seen that it's sort of bottomed in 24. And it's slightly upticking, but not much. I expect it to normalize a little bit, and we'll see it, up, but it's going to be up in kind of that low area. I don't see it going up 30, 40, 50%. I see it being a slow recovery. And that's what I'm going to say about that. So developers starting projects today will be best positioned for success. Just to give you an anecdote about Origin. So we have been developing for, at this point, this is our 14th year. And we did developments in 2012 through 2020. I would group that as one long vintage period. And then the other is that kind of 21 to current period. Today, we have well over 14,000 units in some form of development, whether it's pre-development or we started construction or we're leasing up and stabilizing, or it's preferred equity or it's common equity, and there's lots of ways that we're investing because each fund is a little bit different in its risk return. However, what I'm driving at is we have a really large team on the development side. With 14,000 units, we have an enormous data set. In our markets, we're one of the more active developers in the country. And I'm really proud of our team. What am I driving at? I think we're way better at development in 25 than we were in 2013. Just the experience set, the quality of team, the access to information, the firms and companies that we partner with. I had dinner with a great partner last night in Chicago. So at every level, we're better. However, our returns were higher 2012 to 2020 than 2021 to now. How is that possible? Vintage. Vintage matters. It really matters in development. So what happened 21 to 25? There's 5 variables in development that matter. The first are rents. It's our growth rate. Very important. Second are construction costs, what it costs to build. Third are interest rates. How much is your debt? how much debt you have access to. The next is our capitalization rates, which are also our multiples on EBITDA. We call it NOI. So at a 3.5, it's a 30 multiple. At a 5.25, it's more like 18. So if you owned a publicly traded company and their EBITDA was flat for 4 years, but they started at a 30 multiple and ended at an 18, that's not a good stock performance, right? That's going to really eat into the value of that share. Real estate's no different. We've went from 30 to 18. And then the fifth is OPEX, so operating expenses, which went up quite a bit in the 20 to 25 period due to inflation, wage inflation, insurance inflation, et cetera. So vintage matters. I've never seen this in my career, but we've been in a 4-year period now where all 5 variables went against you at the same time. That's really hard to do because a lot of these variables are counterbalanced by themselves. So, for example, if you're in a very high rent growth period, it's most likely the economy is doing well. That's why people are able and willing to pay more rent. And in economies that are doing well, there's usually pressure on interest rates to go up because the Fed might be raising rates or the inflation expectations are going up. And so they would sort of counterbalance. One's good, one's bad. And that's typically what I've seen, but in this period, it hasn't been the case. I think that we're entering a period where they're going to start to counterbalance and perhaps even maybe 3 out of the 5 go your way. What's interesting is in the period 2025, we still made money. If you're in any of our funds, you made money. It wasn't the money that I expected. I expected to make more money. But in periods where you're going to get vintage right and enter development, that's when you can really get interesting returns. I can't promise you that 25 is the vintage year, but I think that coming out of 4 consecutive non-vintage years, probability is starting to move in your direction. I mentioned this earlier, multifamily construction costs remain flat in 25. I have a huge advantage here. And so the reason I'm able to perhaps, get in that 80th, 90th percentile in these projections, we're out pricing construction all the time. We're doing it right now on thousands of units. And what I've observed and what I talk to our teams about, first of all, overall, construction pricing is flat in the last 8-10 months, which is surprising because with tariffs, the expectation was that input costs would go up. But that's more than mitigated by the lack of activity in the multifamily construction development market, like new starts. Remember what I talked about earlier? There just haven't been many new starts since 23, into 24, into 25. And so a lot of the general contractors and subcontractors are really wanting work. They don't see that they have their teams booked for this job, the next job, the next job. And so when we're going into price, we're actually getting, when they know that we have debt and equity and we're willing, and able to start a deal, we're getting an additional 3 to 5% off. So the net is we were kind of getting flat year-over-year pricing, but it winds up negative. It's -3, -5. And it varies by market. Some markets are even softer than others. Florida is very soft right now, as an example. Phoenix was quite soft, but now it's getting a little bit less soft. Denver has remained a little bit more sticky, but I mean, it's still not going up and maybe not down as much. So it does matter regionally, but the trend is flat to negative. And so for me to say that things will be flat next year, I have a buffer. And momentum is actually moving in this direction. So I feel pretty confident of that. And so if you extrapolate that further and go back to the last slide, if there's 5 variables that matter, I'm pretty confident about one. That's construction costs, right? I'm fairly confident about interest rates too. Like I think that you've got upward and downward forces. I think it's going to be kind of a lower volatility range market, right? So I could go asset, sort of variable by variable, but that's kind of where I'm heading with. I think this vintage is probably pretty good. Controllable multifamily operating expenses will stabilize. Again, I have the benefit of information that they have stabilized. There was enormous spikes really in 21, 22. And the biggest spike was insurance. And it was because inflation had created a much more expensive replacement cost. So if it used to, just for argument's sake, cost $200,000 to replace a per unit stick built multifamily building per unit in the Southeast. Maybe a year and a half later, it had gone up by 20, 25%. The actuarial tables of the insurance companies were pricing in 2 to 3% in inflation because that's what it had been for 30 years. Now they had to look at something that was 25% in an 18-month period. So there was a sort of a shocking one-time event. Notice what I'm not saying. I'm not saying that they're going to deflate, that all of a sudden replacement costs will go from 250 back to 200. That's deflation. I'm just saying they'll stabilize. They'll move into a 0 to 3% normal world, which is what I believe we'll be in going forward. It's not any different than when you go out to eat. A steak at a nice restaurant used to be $35. Now it's 60. Next year it's going to be 62. It's not going to be 90. It's not going to jump up again, probably. But it's also not going back to 35. You're going to grow slowly off a higher base rate, and that's the challenge that a lot of people are feeling in the economy is inflation has slowed, but it's off a much higher baseline. So at Origin, we're really active in credit as well. I think it's a big advantage because we see across the whole multifamily universe, and there's a lot of activities on both equity and debt that benefit from certain market environments. So, like for example, in the last 2 or 3 years, it's been an amazing credit opportunity, and our fund's done really well because the banks retrenched. And we were able to step in and fill that gap and get really good rates and spreads and risk-adjusted returns. But if the banks really start lending a lot, now our equity business will really benefit because we're a net borrower when rates are low, and that benefits you as well. So I'm happy about how we can serve our investors in really every environment through different funds. But credit spreads have been very tight. And I really just think if you look at where they were in 21, they're extraordinarily tight in 21, but that's in an environment where the Fed was intervening with the economy. They were guaranteeing risk assets. They were keeping the risk-free rate at 0. So that, these are substitute goods for the risk-free rate. So they're going to be pulled down. And then you saw them spike a lot in 22. That was that, rate hike cycle, and there was angst around will people start to default at higher interest rates. There was a huge tech correction in 22. People oftentimes forget. It was pretty violent. And then coming out, you've seen kind of this slow move down to where we are now, that it's almost, it's within the same zip code of when the Fed was guaranteeing all these risk assets and we were at a 0 interest rate. So I don't think that spreads are going to widen materially, but I do think that we're kind of on the tighter end of where they'll be. In other words, I think it's more probable that it's going to start trending here than it goes here and starts to match the COVID low. Multifamily capital will continue consolidating towards larger managers. This is a trend over the last 5 years. Really longer. It goes all the way back to the Great Recession. Coming out of the Great Recession, there was a lot of consolidation, and it's continued. COVID did it again. I think it's twofold. One, it requires a lot of great people, capital, infrastructure to serve you, the client, at a very high level, both in terms of returns, communication, infrastructure, business continuity. And these are the types of things that investors, or if you have an investment advisor, are underwriting for. And so I think there's a move towards the larger, and then there's been a lot of M&A activity in private equity, and I think that's a trend that'll just continue. It's kind of ironic because private equity is a M&A field itself. They're trying to, buy disparate companies and then combine and find synergies and economies of scale. But then even within private equity, there's the same thing going on. So I think this is a pretty easy one, both to quantify, and I would be very surprised if this turned around. And then the last is QOZ investors will wait on the sidelines until 2027. So this is a niche here, so just bear with me for a few moments. QOZ law was made permanent when the tax renewal or extension, beautiful bill of this year, was passed. And so with QOZ law, it's stated for the next year, you're not going to get a new deferral. The deferral was until December of 2026. So we have a whole year where it kind of stays exactly where it was. And then starting January 27, an investor who comes in then will get a 5-year deferral and a 10% step up on new money, meaning essentially that's saying you'll get a 10% reduction of your original capital gain. And so there are these wonderful economic benefits of waiting a year. And I think most capital is going to elect to do that. The challenge with doing that is I think investors are overlooking the benefit that you'll lose. And so when all that happens, there's also going to be a complete redraw of all the QOZ maps. And right now, the maps are based on the 2010 census because the original law was passed in 2017 and sort of came into being in 2018. And so a lot of those maps, the areas have changed so much. So, we currently, many of you are our partners, we have sites in the Gulch in Nashville, for example. That's the best area of Nashville, but it wasn't in 2010. It's changed a lot. 15 years have passed. Same in Tampa. We have a deal we're just starting in Old Town Scottsdale. Obviously, Old Town Scottsdale wouldn't be a QOZ today if you based it on the 2020 census, but it was in 2010. It was included. And so just understand that there's benefits and drawbacks of waiting. The deferral will be longer. You'll get a 10% reduction in the capital gain. That's true. You'll also wind up in new maps that are reflective. And then in addition to that, the new law states that in order to be a QOZ, you have to be 70% or less of the average median income. And so that's pretty, you're limiting it quite a bit. In other words, you're going to be investing in gentrifying neighborhoods that, in my opinion, at least in multifamily, will require real local subsidies to make them economically viable, the projects. I don't think that developments work with that limitation. I made it through, and I can only blame myself. I was 52 minutes, and I promised 30. So I'm going to start on Q&A, and I'm going to start. I think I'm going to start a little further up. One moment. Maria, if you're listening in, let's start with, because I know that you sent in some of the emailed in. I want to focus on or you can just in the chat tell me where the lives start. Is that around 23? So I'll get started. Scott, thank you for your question. You were lucky number 23. Of the various investments you currently offer, which are best suited for a Roth IRA account? That's a great question. It's definitely our strategic credit fund. It's also the fund that we just converted into an interval fund. I know that we're going to have a webinar on that fund in particular, but that the interval fund structure, we converted into that structure for a couple of reasons, but the biggest was it serves you, the client, much better. We have to register with the SEC. We have to form a governing board that has real fiduciary responsibilities, including they can remove me as manager if they choose. So there's a lot of rights you get as an investor that are quite good. But the really cool part is, and this is the reason we did it, because the SEC views this as essentially kind of a hybrid between a publicly traded stock. We'll have a ticker and a private manager. It'll be private investments in the fund. I can take Roth IRA and 401k capital into the fund, and there's really no limit on that. And so the best way to invest into any credit fund, including ours, is with a tax account or structure that's tax efficient, because debt, credit, we don't have any ability to write off depreciation or other tax shelters that exist in our other funds. And so here you want to use an account that has tax efficiency in the account, and your Roth provides that. So if you have those types of accounts, a foundation, a Roth, a 401k, these are great investments to put into credit. I'll also say part of the Trump original tax bill, and now it's been made permanent, because we invest in multifamily credit only, we're able to get the real estate tax deduction on dividends. And so you wind up getting an additional 20% reduced tax rate on all dividend income. Other credit funds can't provide that unless they're deemed as real estate. And so it's quite a huge benefit, in particular, if you're in a high tax state or a high tax, just your tax status itself. If you're approaching 35, 40%, you're saving 7, 8, 9% just through that, which is pretty cool. John asked a question, whatever happened to the planned strategic credit fund? John, this is a great question. So that's our interval fund, John, you're asking about. What happened was when the government shut down, we were days away from being approved. And so the SEC obviously shut, and we weren't able to launch because they were shut, but they're open. And so we're kind of like all hands are on deck. We think it's any day. We're going to get the full approval, and we'll share with everybody. You'll get an announcement at that point. I think it's a matter of days or weeks at this point. We were through that sort of 6 to 12 month process. But that's what happened was the government shut down, set us back a little bit. James asked a question. AIER state that most commercial lending does not involve a bank, and that office and multifamily delinquencies are at all-time highs. So delinquencies in office are absolutely at all-time highs. Look, if you're in office investments that were made before they repriced, it'd be very unlikely that they're not deeply impaired. I'll just say that. The problem with office investing going into 20 and 21, and what happened was the cap rates going in were very similar. I'm talking about Class A office. It was very similar to multi, but their demand curve completely changed. And so it was a very mispriced asset. And so some of these losses in office are pretty extraordinary. It's not just the equity that's been lost, but there's been huge losses to the debt and the credit structure as well. In terms of multi, it's very different. Here, a lot of multifamily at the high, that you were paying too much for the asset. It was a 30 multiple. Now it's 18. So that's obviously, it's not good. But in terms of the cash flows and the demand, that hasn't changed. In office, you got both. At Origin, what we did during this period, because there are delinquencies, and make no mistake, there are delinquencies and there's distress in multi too. And it's typically people that overpaid for value add deals and didn't fix their debt. These are sort of the threads that create the problem. We didn't do any of those things. We didn't buy value add and put on cheap debt. In fact, we went 4 years without buying a building at all. From late 2019, I shouldn't say that, early 2020. It was February 2020. We bought Monroe. It was our last acquisition. And we didn't buy anything until the fall of 24. So talk is interesting, and sometimes it's, like I would like people to be fact checked in a presidential debate or in business. I think actions kind of speak for themselves. Like if I had an opinion and Origin had an opinion, but we continued to buy in 22 and 23 and 24, I would have no credibility, right? Because I didn't act on it. So anytime I hear people talk about what they think, or I'll give you an example. People in 21 or 22 that said they were nervous about interest rates because the risk-free rate was so low and they were nervous. I mean, if you're a manager and you're nervous, that's just a feeling. I mean, that's not helping an investor. Like do something. If you're nervous, swap your debt. If you're nervous, fix your debt. If you're nervous, do something, right? Like that's what you're paid to do. You're not paid to be nervous. You're paid to do something. Ted asked a question: in existing QZ deals, what are the deciding metrics to determine whether expected development projects? Because this is a question. So Ted, reach out to me individually. So my email's right there. I'm happy to answer any question about any fund. This is more of a macro discussion. I can give you a macro answer, but I also will talk to you directly, or we'll have a team member do that. Our QZ funds, if we haven't started a development, our metric is always the return on cost. And we generally want to be building anywhere from, let's say if we think in Phoenix, good location, spot cap rates 4.8 to 5. We want to be kind of 6 to 6.2. In other words, 20-25% unlevered margin. That's what I'm looking for. And there can be a little bit of noise, but for the most part, that's what I'm looking at. And all the variables I mentioned, Ted, are inputs into establishing the return on cost spread. Anytime you do development, you have to be compensated to take that unit of risk. Zorik asked a question. NAREIT residential REIT index total returns for 10 years is 674. Well, 5 year is 506, since most of the returns from income. I got cut off here. It's quite a question. Sorry, I got cut off. Most of the returns from income, these low returns imply low price appreciation. Yeah, I agree with that. You're absolutely right about all of that. Your question is more, I believe, the tenor of it is, if they haven't gone up much in the last 10 years, why would you expect them to go up now? That's precisely why I do think they'll go up now. I believe that, we're a country with a positive birth rate. We produce more people than most Western nations. That's our demand segment. Immigration's part of that too. I'd like to see legal immigration continue. But we're underhoused, we're a growing population, and our returns, which historically, like, you're right about what you're doing here with NAREIT, but if you expanded this from 10 years to 30 years, you'll see that it keeps going up. It's higher at 10 than 5, it'll be higher at 20 than 10, higher at 30 than 20. I think there's going to be mean reversion back. And it's another way of saying, I think you're getting in at a great valuation into an asset class that has real demand. That's my opinion. And ultimately, as investors, you have to make a couple decisions. One, is this an asset class that you think will hold and grow value? And the second, which is equally important, maybe more, if I'm going to enter the asset class, who am I going to partner with? Like, am I going to do it myself? And if I don't, if I'm going to use a manager, who is that manager going to be? Manager selection really matters. Back to the example I did around development, in a very sort of difficult market over the last 3 to 4 years, we've made meaningful returns for you. So if you're in QZ1 or 2, you've made money with us. If you're in our Growth Fund 4, we started in 21, difficult vintage, you've made money with us. But if you invested with us in 13 or 14 or 15, when it was pretty good vintages, that's when you can really make outsized returns. And so I like, as an investor, I like games that when they're stress tests, you still make money. And when it's, average, you make more. And when it's good, you make a lot. So that's kind of what I've seen through our development. And that's why I'm a big investor in all of our development funds. You have to, as an investor, ladder what you do, meaning, for every dollar I put in development, I put at least that in strategic credit, because to me, that's 10 to 12% that I can really rely on in any environment. And so it makes me feel better about trying to earn more, but it's more volatile, right? Development is inherently more volatile in your return expectation. You can get 30%, you can get 15%, you can get 10%. Credit is going to be more like 8 to 12. It's not going anywhere. So I like that. Manon, what's your view on the maximum 10-year rate that will be tolerated? I don't have an answer for maximum. I told you what I think. I think absent the secular move that's more powerful than the tariff move or even the absolute amount of debt we have, I think if you didn't have this counterbalance of efficiency through AI and automation, I would say that there's no reason that rates couldn't go to 5% in the 10s. But I think because of that, that's not the paradigm we're in. I actually think there's equal risk. And if you made me answer the question, like, no, that's too middle of the road, I would tell you it's more likely that rates will go lower, because partially the business cycle, we haven't had a true recession in quite a while. There is some, it's mixed, but there is a trend towards lower employment that we've seen. The government hasn't been open for quite a while, so we haven't seen a lot of data, but the trend right before the shutting was that there was a softening in the labor market. That's business cycle stuff, but like I would say the secular move towards efficiency through AI is a really powerful cap on wage inflation, and so I would tend to think that I'd be more concerned about rates going down. Rates going down aren't necessarily good if they're going down for the wrong reason. I mean, if they're going down because we're underemployed and in recession, I'm not sure we want to celebrate that. Where are real estate credit rates headed over the next year? We covered this a little bit. I'm not really concerned about the risk-free rate. Covered that a second ago. And then the next is, where do you think are happening with credit spreads? Because credit spreads are the spread that manifests in my own borrowing rate, right? I don't borrow at the risk-free rate. I borrow at a spread above it. And I addressed that in another slide, Manon, which was essentially saying I think spreads will go out a little bit, but really be stable. So again, I'm not that worried about risk-free rate or the risk rate right now. At Origin, we do fix all of our rates as deals become stabilized. And so I can have an opinion, but I'm always hedging. And at Origin, we're always hedging when appropriate and it's just a normal business concern. So if you see us moving assets into fixed rate debt, it's just because that's what we do. We want to capture the development margin, and then we want to fix rates so that we can focus on the areas that we think we can outperform in. right? I don't want to win because I didn't hedge rates and then they went down. Todd asked a great question. What's reasonable return expectations on ground up development in multifamily, assuming 4 years? Yeah, and you sort of answered your question. And so in a kind of bad vintage, which was 21, I think 9 to 11 net, I think that's what we'll deliver. First of all, I think if you're in these funds, that's what you'll get. I wish it was higher, but that's probably what it winds up being. And if we're in a good vintage, anywhere from, I'll just be really broad because there's tails, 15 to 35% IRRs. So these are significant multiples, and I'm basing this on real deals. You know, we've done 2.5x on money, 3x on money, 4x on money. There are tails. Tails don't just exist to the downside. They're all part of a distribution, right? And so I would say when it's good, it can be quite good. Brett asked, do you expect reshoring of manufacturing to fizzle out or even actually happen? I'm really, I said this earlier, I'm very optimistic on the infrastructure build out around AI and the creation of a new, sort of next gen manufacturing here. And so I think that's where we can really win, right? Will there be some reshoring? Absolutely. And there's things happening that are kind of unprecedented with public-private partnership, government investment in exchange for equity in companies. I mean, these are things that are very, very different than the America I was raised in, right? The America I was raised in wouldn't take a stake in a public company through investment. I mean, that's not the Reagan vision, right? But I'm not even judging it. It is what it is. Like, this stuff is happening now, and there'll probably be some benefit to reshoring. But I think the last gen manufacturing, it's probably too late. It's too late to compete with Taiwan Semiconductor in the U.S. in what they do. But it's definitely not too late because everyone's building it right now, the next gen. So that's where I would be more hopeful, and it's so large of an opportunity set. Jonathan asked, it obviously won't happen in the medium term, but don't you think that if the low employment deflationary scenario plays out, the government will institute some form of social safety net? That's I hear that a lot. So yes, it's being discussed a lot. I think that, I believe his name was Andrew Yang, and it wasn't even in the last election, presidential election. I think it was the one before that. He raised it then, which would have been 5 years ago now, 5 or 6 years ago, this idea, and this is like pre-AI, and it was very revolutionary. He was the only Democrat really saying it. So when things are introduced, they seem crazy at the time, and then they come back 5 or 8 years later, and then they're all of a sudden mainstream. I think that you're right. If this were to happen, there's a lot of ifs, right? If all the infrastructure being built out for AI is economically viable and it's adopted to scale, and if that scale comes with efficiencies that create pressure on wages and even job creation that are greater than the innovation that unlocks new jobs, these are lots of ifs. But if all those things happen, and it happens quickly, and a lot of people, that's like their baseline. They go right from, we're where we are to we have to be like a radically different economy in a year. And I don't believe that. I think that things take longer, and there's lots, we're human, and, AI and the executives at these firms, and they're not infallible. They're going to make mistakes, and there's going to be huge miscalculations and all kinds of stuff. I think it's going to take longer, and it's going to be a lot messier. than the economy, maybe the market assumes. But eventually, if they get it right, it'll take longer, and you would be at a place where, if all those things happen, you would have to start to have conversations about how are people going to have that level of income. By the way, the other question, Jonathan, that we would have to talk about is, if all those things happen, we would need to completely change our tax code too, very quickly. So like if you thought it was going to happen really quick, well, Social Security and Medicare are funded by payroll tax. There won't be payroll tax, right? There'll be less payroll tax because there's no method right now to tax AI or tax a robot. So you would have to totally change that to a production-based tax rather than a wage-based tax. And it would have to happen really fast, or you actually wouldn't have money to pay Social Security. So there's a lot of if-then statements. But I think things will take longer than we think if it's the pronounced effect at all that we're assuming. It's 2 hours and 17 minutes. I will continue to answer a couple. Dennis asked, I thought current building costs favored buying versus building. Seems like buying has better forward risk-adjusted return. Why do you see this differently? Again, this is so Dennis, this is a really broad. It's not that you're not accurate. You're contextually accurate in certain instances. So, in certain types of construction, high-rise, podium, in certain markets, it's true that you can buy below replacement costs, but in lots of other markets, it's not true. So like it depends on the market, it depends on the location, it depends on the type of construction. And so I would say that in 2021, it was very, very obvious that stuff was priced way above replacement costs. And now it's kind of on the margin and mixed and idiosyncratic to the deal. So I use mainly as my compass, like what I said before, which is if something is trading, just say plus or minus 5, say how we underwrite as a stabilized cap rate, we want to develop to a 6.3, 6.4, 6.5, and that's our margin. And if we can do that, I'm interested. That's more my compass. I do look at replacement costs too, but I will tell you that they tend to swim in parallel slopes, right? So you're not developing something that you could buy, way below today, and it's also a 30% margin. That's impossible, right? So there's different lenses, but they tend to sort of corroborate each other. Manan asked a question, does Multilytics have an opinion basically on infrastructure build out in the US? I think you're asking surrounding AI. We've had these conversations and there's various ways to do this. I mean, you can have an overlay of a recession, for example, which lowers your demand curve. You can have an overlay of AI disrupting labor, which I think is what your question is. And what would it do to the demand curve? And then what would that do to future rent predictions? And candidly, we do have these models that assume these things. It is challenging in an AI world to have models that you've trained over years and years and years and with billions of pieces of data that are unbiased. It's challenging to then inject bias into something that was supposed to be unbiased. And that's what you're doing, right? You're saying, hey, go learn all this with all this data. And then, well, by the way, I have an opinion and I want to overlay the fact that the whole world will be different or we're in a recession or all these things. So it's intellectually difficult to do that. Although we do scenario analysis because I want to see what increment of difference it looks like. But I'm not we're not taking the model and inherently changing it based on what is an outcome. You can assign your own probability, right, to that. Okay. With that, it's 2 hours. It's 1 hour and 20 minutes. Thank you so much for your time. We did have more questions than I answered, and I think you were a victim of my overly long presentation. Hopefully it was interesting. The other thing is David at origininvestments.com. If I didn't answer your question, continue the dialogue. Just send me a note. I will either answer it. We can set up a call. We can set up a call with our team. And we will be publishing the 2024 predictions, I want to say in 2 or 3 months. And so we'll let you take a look at that as well. I appreciate it. Have a great holiday season, everyone. Bye-bye.